The global financial system just received a warning shot that most people will ignore until their portfolios are cut in half. On Tuesday, January 20th, 2026, something happened in Asia that should make every American investor sit up and pay attention. Silver closed today at $94.87 per ounce. Gold reached $4,735.60. These aren't projections or predictions. These are the actual market prices right now, and they're screaming a message that Wall Street doesn't want you to hear. What triggered this surge? A crisis unfolding in Japan's government debt market that's about to force the Federal Reserve into a corner they've been trying to avoid for over a decade. Japan's 30-year bond yield exploded upward by more than 8.6% in one trading session. Their 10-year yield punched through 3%. To put that in perspective, moves like this typically happen in failed states, not in the world's third largest economy. Not in a country that owns more United States Treasury bonds than any other nation on earth. This isn't market noise. This is the sound of a structural pillar cracking under pressure it was never designed to handle. And when that pillar collapses completely, the Federal Reserve will have exactly one option left. And it's the option that sends precious metals into a price range most investors think is impossible. We're going to break this down in 3 critical sections. First, I'll show you exactly what's breaking in Japan and why it matters to your dollar-denominated wealth, regardless of where you live. Second, we'll examine the impossible choice facing the Federal Reserve and why every path forward leads to currency destruction. Third, we'll map out why silver at $95 is just the opening chapter of a much larger story. Let's talk about debt. Japan has been carrying a debt-to-GDP ratio exceeding 200% for years, the highest among developed nations. They maintain this unsustainable structure by artificially suppressing interest rates to 0 and below. This created a phenomenon where Japanese investors had no domestic options for returns. They were forced to look abroad. They poured money into United States Treasury bonds. They funded European debt. They became the fuel for carry trades that inflated asset prices everywhere, from tech startups to luxury condos. Think of Japan as the world's cheapest credit card. Hedge funds and institutions borrowed yen at essentially 0%, converted those yen into dollars, then invested in anything returning 5 or 10%. Pure profit, zero cost, until today. When Japanese bond yields spike like they just did, 2 simultaneous pressures emerge. First, the cost of borrowing yen explodes. Every leveraged player who borrowed cheap yen to buy expensive assets suddenly faces margin calls and forced liquidations. Second, Japanese institutional money, the massive pension funds and insurance companies that have been hunting for yield overseas for decades, suddenly has an attractive option at home. They can earn 3.5% risk-free in yen without taking on currency exposure or geopolitical risk. That's the magic number they've been waiting for, and they're taking it. This triggers repatriation. Japanese capital's flooding back home, but to bring that capital home, they must sell what they purchased abroad. United States Treasuries, European bonds, equities, real estate, everything gets liquidated. Japan holds approximately $1.2 trillion in United States government debt. They're America's largest foreign creditor. If they liquidate even 10% of that position to stabilize their domestic bond market, that's $120 billion of selling pressure hitting the Treasury market in a compressed window. When bond selling accelerates, yields rise. When United States Treasury yields rise, the cost to service America's $38.6 trillion national debt rises in lockstep. The United States government is already spending over $1 trillion annually just on interest payments. If yields climb another percentage point or 2 because foreign demand vanishes, that interest expense becomes mathematically unsustainable. The budget implodes. The government cannot finance itself through traditional borrowing. Here's where the Federal Reserve walks into the trap. They face 2 choices, both catastrophic. Choice 1, allow interest rates to rise high enough to attract new buyers for the debt. This collapses the housing market, destroys regional banks, and triggers a deflationary death spiral. Choice 2, become the buyer of last resort. Print dollars out of thin air and purchase the bonds that Japan is dumping. This is called debt monetization. It's the nuclear option, and it obliterates the purchasing power of every dollar in existence. The market already knows which choice they'll make. That's why gold hit a new all-time high today. That's why silver blew past $95. Institutional investors aren't buying precious metals because they're worried about inflation. They're buying because they understand the Federal Reserve has no exit strategy that doesn't involve mass currency creation. This isn't an inflation hedge. This is a bet against the credibility of fiat money itself. Now let's discuss why this crisis is fundamentally different from 2008 or 2020. During previous financial shocks, central banks around the world coordinated their responses. The Federal Reserve opened currency swap lines with the European Central Bank and the Bank of Japan. They synchronized interest rate cuts. They printed money in tandem. The crisis was global, so the solution was global. But the geopolitical architecture that enabled that coordination is fracturing. President Trump recently threatened tariffs on 8 European nations over a territorial dispute involving Greenland. European leaders are discussing economic retaliation. Analysts at Deutsche Bank estimate that European countries collectively hold approximately $8 trillion in United States bonds and equities, nearly double what the rest of the world holds combined. If political tensions prevent coordination, or worse, if European governments reduce their purchases of United States debt as economic leverage, the Federal Reserve will be forced to print far more than they otherwise would. Because the gap left by foreign buyers must be filled by someone, and that someone will be the central bank with the printing press. This is the perfect storm. Japan is selling to save itself. Europe might stop buying to counter tariffs. China has been quietly selling for months. The only buyer left standing is the Federal Reserve, and the only way they can buy is by creating new dollars from nothing. That's currency debasement at institutional scale. That's the environment where hard assets decouple from fundamentals and start tracking the rate of currency destruction. Let's examine what the market has already told you today. Silver was up 4.38%. Gold gained 3.24%. But here's the detail most analysts are missing. The gold to silver ratio briefly dropped below 50. In precious metals, bull markets, that's a significant signal. Silver outperforms gold when fear transforms into panic, when institutional capital starts fleeing bonds and fiat currencies. Silver moves faster and harder than gold because the market is smaller, the float is tighter, and the leverage is more extreme. Platinum surged 5% today. Palladium broke through resistance levels. The senior gold miner ETF gapped up over 5%. This isn't a one-day headline-driven trade. This is confirmation across the entire precious metals complex. When mining stocks confirm a breakout in the underlying metals, it signals that the market believes this rally has structural support. It means smart money is positioning for a sustained move, not a short-term volatility spike. And then there's Bitcoin, back below $90,000 while precious metals are hitting all-time highs. The so-called digital safe haven is bleeding capital. This matters. It reveals that when genuine systemic stress hits, when bond markets are breaking and central banks are trapped, capital doesn't flow to speculative technology. It flows to the assets that have preserved wealth through every crisis in human history, gold and silver. So where does silver go from here? Let's use historical precedent as our guide. In 2008, when the financial system collapsed, silver initially crashed from $20 to $9 in the liquidity panic. Then, the Federal Reserve announced quantitative easing. Silver rallied from $9 to nearly $50 over the next 3 years, a 500% gain. In 2020, when the pandemic struck, silver fell to $12. Then the Fed printed $3 trillion in 5 months. Silver doubled to $30 in that same period. The pattern repeats. Crisis triggers crash. Crash forces intervention. Intervention causes rally. We're currently in the phase where structures are breaking. The Japan shock is the initial crack. The printing phase is approaching. It's not optional anymore. It's structural necessity. The Federal Reserve cannot allow the Treasury market to fail. When the printing starts, we're not beginning from $12 like in 2020. We're starting from $95. A simple double from current levels puts silver at $190. But let's discuss the real target, the one that sounds absurd until you understand the mechanics driving it. If the Federal Reserve implements yield curve control, meaning they cap Treasury yields at a specific level and print unlimited money to enforce that cap, the entire game changes. Yield curve control represents surrender. It means the central bank has abandoned fighting inflation to save the government from insolvency. Japan used this policy for years. Now the United States will be forced to adopt it. When yield curve control gets implemented, bond investors realize that returns are capped, but currency debasement is unlimited. That creates a panic rotation out of fixed income and into real assets. Gold typically leads because it's the largest and most liquid market, but silver follows with greater percentage gains because its market is smaller and tighter. In historical monetary crises, the gold to silver ratio has compressed to 40-1. At current gold prices, near $4,700, a 40-1 ratio puts silver at $117. If the ratio compresses to 30-1, as it has during previous manias, silver reaches $156. And if we witness a true panic, a 1980-style blow-off top, the ratio could hit 15-1. That puts silver at $313 per ounce. These aren't fantasy numbers pulled from optimism. They're mathematical outcomes of a predictable sequence. Sovereign debt crisis forces central bank intervention. Intervention destroys currency confidence. Destroyed confidence drives capital into hard assets. The smallest hard asset market, silver, experiences the most violent price discovery. But understand something critical about the path from $95 to $150 or $300. It won't be a straight line upward. There will be sessions where silver drops $5 in minutes. There will be margin calls and forced liquidations where hedge funds must sell their winners to cover their losers. These are shakeouts, deliberately designed to terrify retail investors out of their positions. The banks holding short positions in paper silver need you to panic and sell your physical metal so they can cover their exposure at lower prices. If you're holding physical silver, actual metal, and not leveraged derivatives, you can survive the volatility. You can ride through the shakeouts. The only participants who get destroyed in bull markets are the ones who panic at the bottom of temporary corrections and sell directly into the hands of institutions covering their short positions. Right now, the macroeconomic setup is textbook perfect. We have structural industrial deficits. Demand from solar panels and electronics is growing and cannot be easily reduced. We have geopolitical fracturing. The Western alliance is showing cracks that could prevent coordinated central bank responses to the next crisis. And now we have the Japan shock, a sovereign debt event forcing the Federal Reserve into a position where the only exit is the printing press. The three pillars of a silver bull market are locked in place. Industrial demand that cannot be satisfied. Geopolitical chaos that prevents solutions. And monetary desperation that forces debasement. There's nothing left suppressing the price except paper manipulation, and paper contracts burn when sovereign bonds are breaking and central banks are trapped. You've positioned yourself ahead of the institutional wave if you're already holding silver. You understood the debt dynamics were unsustainable before the mainstream financial media started covering it. Now you need to maintain your position through the volatility, because what's coming next isn't a correction. It's a repricing. A complete repricing of what an ounce of silver is worth in a world where the global reserve currency is being printed to prevent a bond market implosion. The butterfly flapped its wings in Tokyo this morning. The hurricane is forming over the Treasury market. And silver is the only asset positioned to benefit from both the storm and the response to it. Hold your position. Filter out the noise. The mathematics are unfolding exactly as the debt cycle predicts. If you found this analysis valuable, hit that like button for Federal History. The data doesn't lie, and neither do we.